and welcome to this edition of Closing Trades. Right here in ET Now with me, Aisha Faridi, Srishti Sharma with me in the studios, and it's fairly consolidative and quiet in today's trading session. Just mildly higher is how we are, but not complaining given the kind of move that the markets have seen in pretty much the last 10 days and especially yesterday as well. It's a little bit tempered. The handover from the globe, of course, was weak. What with the move coming in the US equity markets, of course, overnight, wherein you saw pretty much across the board a 2.5% cut. But this morning, Asia has managed to actually pick up a little bit, while Shanghai has been marginally higher. Hong Kong leapt it up almost about 1%. That's not quite the move, though, with Europe. Those markets have started off a little bit tempered. About a 0.5% kind of cut is what you're seeing for the Stock 600, the CAC, as well as the FTSE MIB, though the FTSE is just about flat with a positive bias as we speak right now. Individual stocks, it's IIFL, which is holding up 6.5% as we speak right now, or 361 WAM. There's Dixon. There's Phoenix Limited, Berger Paint, Max Healthcare. So a lot of these mid and small caps are where you're seeing bigger buoyancy as opposed to what the benchmarks are doing. Having said that, HDFC Bank, consistently an outperformer, and today's no different after the new LCR rules, higher by about 33 odd points or so. It's a good 2% of a move that you're seeing for HDFC Bank. M&M as well, 2% higher there. There's Geo Financials after its numbers, a good 2% move coming in there. And then Kotak and ITC as well are due contributors, along with, of course, SBI, which is also holding out very smartly in trade. Let's welcome on board then our experts and figure out what is it that they're making of the market right now. Kunal, a little bit of consolidation, but how long could it last?
Yeah, I think it's a good sign that the markets are consolidating, because today is for the first time we're seeing the market breadth opening up. You're seeing mid caps or tier to large cap names, they're showing signs of strength. So it's not the usual outperformers in the large cap stocks, I think, except for maybe few of the handful stocks, like HDFC Bank, which are showing signs of exceptional up move. But I think other than that, it's a good overall market breadth. We're holding on to that 24,000 mark, and I think that's the more comfortable sign, which I would, I would be looking out for. The Bank Nifty is, gaining strength. 55,500 plus is now the new support for the bank index on the short-term basis, and we've climbed almost 5,000 plus points for the Bank Nifty in just the last 5-6 days. So there could be a point over the next 1 or 2 days that you might see some bit of minor correction which could happen into the indices because of the way the run-up has happened over the last 5-7 days. But no complaints till the time we hold on to those strong psychological mark. In this case, 24,000 for the Nifty and 55,000 as a round figure for Bank Nifty.
All right, so those are the levels to watch out for when it comes to the index. Really good moves, and it's good that we are consolidating at this point in time. But in the last half an hour or so, we have seen so many sectors coming in on the forefront to lead the rally, and one such sector is the FMCG space, because just today we were discussing about the prospects or the factors that could give leg to the rally, or rather growth triggers for the whole space. And today, of course, UBS has come out with a note where they are saying that the consumer sector is a Goldilocks in the making. We have discussed about some of the stocks like ITC, even HUL, why these counters are in focus and what is UBS take on this one. But Kunal, help us with a chart check on this one, and specifically the top 3 gainers that I spot between ITC, HUL as well as Tata Consumers. These 3 companies are in the top gainers for Nifty 50. Any stock that still offers opportunity?
So I think HUL at current levels looks attractive. In fact, HUL and ITC, both of these stocks, they were relatively strong in the last 1 week, 10 days. You had seen moves of, I think, 5 to 7% broadly from their previous swing lows for these FMCG names. But I think today what we're also seeing is that these stocks are coming out of their minor zones of consolidation, and that too on the back of slight increased volume activity. That, I believe, could be a very interesting signal or a technical indicator to watch out for, because when you generally expect that these stocks come out of the consolidations on the back of incremental volumes, that too on an expiry week, and that too after a point where over the last 6 months or so, these stocks have fallen 20-25% broadly. So I think that's generally considered to be a comfortable sign that you're looking at long built-up formations happening into these names, as well as a blend of short covering. So I think all of that should augur very well. I would look at HUL at current levels, and my sense is that the stock could now probably look good for at least another 150 points on the upside over the very short term.
Okay, that's the take coming in on what some of the FMCG names are doing, but you can't take your eyes off from what's really happening with banks, because that's where the utmost leadership is, and of course got a good fillip from the central bank itself as well just last evening. the fact that they are, or rather they have given another boost to liquidity. There's been a change in the stance from the regulator. The RBI clearly seems now more favorable towards banks than before. But before we address what's really going on with banks, let me take it across to Snehi and get in an outlook from what the House of UBS has to say about FMCG as a pack.
Well, absolutely. So when it comes to the entire FMCG and consumption space, this morning UBS has come out with a note, and they believe that the consumption sector is a Goldilocks in the making now. They say that the consumption sector is ready for a rebound now, and earnings growth is also likely to recover in FY26. They're penciling in a 13% growth after a weak FY25. When it comes to margins, they believe that headwinds will recede in the second half of FY26. That could bring about some improvement in EPS, and that could be a catalyst turnaround point when it comes to the entire FMCG space. Now, they've also listed out some factors due to which the demand for FMCG could improve, and they're saying that the low the tax cuts that have been announced in the budget could prove to be a major fillip. Rural demand is already looking resilient, and Rabi output this year is also expected to be strong. The falling food inflation could also could aid demand. The upcoming 8th pay commission over the next 3 years could also prove to be a fillip for the sector. And when they talk about valuations, they believe that valuations have now corrected significantly. Remember, it's been a 35% fall from the October valuations for FMCG stocks, so that's also looking compelling. And the sector offers defensiveness in the market that may continue to have low risk tolerance as of now. Now, let's understand their stock specific view. They prefer DMart and Trent as income stimulus plays. As turnaround plays, they like HUL and GCPL. Colgate and Britannia also, they believe, are at an inflection point, and earnings growth revival is likely in the next year. They see appealing value in ITC as well. On the flip side, what they don't favor right now is Asian Paints, Dabur and Jubilant Foodworks. So if you talk about their rating, there's an upgrade coming in on HUL, ITC, Trent as well as Colgate. They've maintained their rating on DMart, GCPL, Britannia and Titan. And for the other stocks, the likes of Marico, Asian Paints, Dabur and Jubilant Foodworks, it's a downgrade coming in ratings as well as target price.
All right, thank you so much, Snehi, for highlighting all those details. But one such stock that you were mentioning was Asian Paints. Well, of course, UBS is not that bullish, but one of its peers that is doing very well today, that is Berger Paints. And Kunal, if you can quickly help us with a chart check on this one, because off late we haven't seen such big moves coming in on Berger Paints, but what's special today?
Yeah, in fact, it's the 4th straight month for Berger Paints that the stock has done reasonably well, from 450 as a base towards 580 mark where it's trading right now. And I think on a relative strength basis also, Berger Paints has done exceptionally well as compared to Asian Paints. And maybe the prime reason for that would be the lower volumes the stock had seen when it was at those 450, 450 to 470 kind of a mark. I think in the month of January, February, from there on, the stock had started to form a base building process, and now we are looking at the stock getting the momentum as well as heading towards breakouts. This could be a very strong potential move for Berger Paints, and the next level of targets which you can look would be where the stock halted in the previous year, where I think in June or July 2024, the stock took resistance at the 650 mark. So we could be potentially at a point where Berger Paints can provide at least another 8 to 10% upside, come closer to that 650 mark.
Okay, that's that on Berger Paints. In the meantime, just want to look at what's happening with banks, and we said we'll address that. The fact that RBI now seems more favorable towards banks than before, and of course, just last evening they announced the final liquidity coverage ratio or LCR guidelines for banks, which are positive rather than negative, as was expected by the market earlier. The RBI has increased the runoff rates for deposits enabled internet and mobile banking system. The increase in the runoff factor is only about 2.5 percentage points as compared to the 5 percentage points which was suggested in the draft circular. Let me in fact take it across to Gaurav and try and understand the implications for banks, which stand to gain most, and what brokerages are now saying about the same.
Absolutely a very big push for banks in terms of liquidity from RBI, because now RBI has finalized the LCR norms, which were much awaited norms. And first, let's understand what are the changes. First, that they have assigned additional runoff factor of 2.5% for any kind of deposits which are accumulated from internet and mobile banking. They have also said that government bonds will be valued after applying a haircut. But what is a big positive is that they have actually lowered the runoff factor for non-financial wholesale deposits from 100% to 40%. Now there is a 60% fall in this runoff factor, which can actually boost the LCR, because this will actually help the banks to reduce the denominator for LCR ratio. Now let's understand what is the benefit is going to be. First is that liquidity buffer is going to get reduced. Other is that there will be sufficient time for transition, because RBI has said that this will be applicable from 1st April of 2026. So definitely a very much time that banks are getting. And lastly, it will also boost the LCR ratio for the bank, which can actually boost the deposit growth as well as advances growth for the banks. We also have some brokerages. So first let's talk about IIFL. What they are saying is that in fact they have actually pointed out some of the names in the likes of Federal Bank, RBL Bank, Kotak Mahindra Bank, HDFC Bank, who could actually see the benefit because of the high proportion of non-financial operations. In fact, when we talk about Investec, they are also very bullish about this move. What they are saying is that we may see an positive impact of net interest margins somewhere in the range of 3 basis points, and it can also boost sector's ROE almost by 20 basis points in FY27. In fact, RBI itself has said that it will actually give LCR a boost of 6 percentage points versus what the street was expecting earlier of 11 to 19 percentage point of negative impact from the draft norms that we had seen. We also have Macquarie, who said that this can actually improve the credit growth almost by 140 to 160 basis point. And lastly, we also have Morgan Stanley, who say that some of the benefits can also be seen in FY26. So definitely a very positive move in terms of liquidity for banks, and definitely on the back of this we will be watching out on the entire sector in the day to day.
All right, thank you so much, Gaurav, for getting us all those details that what is the new norm about and what could be the implications. But on the same topic, we also had a word with Rikin Shah, who's a Senior Vice President at IIFL Capital, as he discusses the impact of this on the banks. Listen in.
The banks where we expect the benefit to be relatively more are the ones who have higher proportion of this non-financial corporate deposits, because that is where the runoff rate has come down from 100 to 40%. And the banks which qualify in this will be the likes of RBL, Federal, Kotak, HDFC and Bank of Baroda. So these 5 banks will see relatively more benefit from this final LCR guideline. On the other hand, someone like ICICI Bank is unlikely to see any meaningful upside from the current guidelines. Federal, RBL, Kotak, HDFC and Bank of Baroda, the margins can anywhere improve from 5 to 18 basis points for them, and the PAT can improve anywhere between 1.5% to 4%. RBL is an outlier where the PAT the PAT benefit can be as high as 12-13% as well.
Welcome back to Closing Trades right here on ET Now, and let's also welcome Rajesh Kothari on the show right now. He's the CIO of AlfAccurate Advisors. Hi Rajesh, good afternoon. Good to be speaking with you, and it's turning out to be a great afternoon for the markets as well. And in the last couple of weeks, a lot has changed in terms of the perspective, in terms of the fund flow for the Indian markets. Help us understand that how are you seeing the markets right now, and also any sectors that you believe that are looking good even in this environment?
Yeah, hi. So I always believe, that the maximum point of uncertainty always creates the maximum point of potential upside returns. And if you actually go through the previous 2 episodes, COVID time as well as Russia-Ukraine war, while the effect on economy was for 2-3 years, like Russia-Ukraine war is still going on, but the market discounted it much early. During COVID times, within 30 days, market came down by 40%. During Russia-Ukraine war, for the first probably just 90 days, market went down by 14%. But the effect on economy was for 3 years. So I think that this time is no different. The Russia-Ukraine war kind of thing, and therefore now the US tariff war kind of thing, they all have many parallels. So I think the effect on market, by and large, if you ask my personal view, the effect on economy will continue, but market is already discounted the worst part of it. So from here on, like I mentioned during our last interaction on 9th April, that every day is going to be a better day in terms of the news flow perspective. So the worst of the news flow is over. Whether worst of the market is over or not, only time can say. Very difficult to predict the short-term moves of the market. But generally speaking, when the worst of the news flow gets over, the worst of the sentiments gets over, and then the flows also starts. Even otherwise, fundamentally, the effect on economy is not much compared to many other economies in the world. And I think India is at a very, very right point. Of course, as a country, we need to do a lot of things to make sure that we do not waste this opportunity. such opportunity comes probably once in decade or once in century, and I hope we don't lose that opportunity.
Right. Okay. That's the take coming in on the overall market. Rajesh, hi. Afternoon. Good to have you on the show. Just wondering what the impact of the new LCR guidelines is going to be on not just liquidity, but what it would mean for banks, given that RBI has now got a solid backing, it seems, for banks.
Yeah, I think, the banking is one sector which we have been bullish on from last, I would say, last 2-3 quarters. And it remains one of the, largest portfolio composition for us. And not only the recent announcement, but if you look at from last, I think 3 months, series of announcements made by RBI to improve the overall liquidity in the system. And the liquidity is like oil. So once liquidity starts, the growth, the multiplier effect of that liquidity, you see in the system. So I think both NBFCs as well as select banks will benefit out of it. But overall, I think that's very, what I would say, specific view. But otherwise, for the banking industry in general, these are good news. See, from the banking perspective, the asset quality is still one of the best, compared to last 5-7 years. We are not seeing any significant dent in asset quality. There were a lot of concerns and apprehension that the retail side of credit asset quality may start getting kind of a poor. But if you look at the recent results by the 2 largest banks, there again the asset quality has been doing extremely well, even on the retail side of the book. So I think the asset quality is still holding up. Inflation is coming down, interest rates are coming down, the liquidity is improving, and therefore I hope that finally from second quarter onwards, the credit growth improves. And I think that's one important thing what we all are waiting for, that the non-food credit growth, I hope we go back to those days of 12, 14, 15% rather than 8, 9, 10%. And valuation wise, we are still comfortable on banking, so it remains one of the largest sector in our portfolio.
Right, that's the view coming in on the banking space. But if we look at the diagnostic space, that is also doing pretty well for itself. Well, of course, stocks like Dr. Lal Path Lab, they are holding up well. But one such stock that is up around 10%, Kunal, what I can see is Thyrotech. Because in NSE 500, that's the second gainer of what we see. And like you were just also mentioning the fact that this is the first time that we are seeing the broader end of the market participating. Do you believe this is the stock or this is the space to look out for, because it's a low beta and the volumes are also quite low?
Yeah, so this tells you that the markets are now looking out for more trending opportunities. This also tells you that the markets have started to open up the risk appetite, not just in terms of short covering, but in terms of starting to build portfolios, as well as look out for quality stocks at discounted prices for these kind of sectors. So I believe that's a positive sign overall, and that's what generally distinguishes a short-term rally or a bounce back or a dead cat bounce into more of a trending move into the indices. Because when you see the market breadth opening up, when you see the risk on appetite coming back, when you see long built-up formations into such kind of names, that generally uses confidence into overall market. And again, I think today's move for Thyrocare is on the back of some extremely strong volumes. The volumes today on the cash on the NSE segment is almost twice or thrice the volumes over the last average of the last 5 to 6 days, when the stock was just about trading with a very mild kind of a positive bias. So that itself indicates that we could be looking at a cusp of a breakout for many of these stocks, including Thyrocare.
Interesting. That's the take coming in on the diagnostic space. But Rajesh, what is your own view? I mean, I know it's not the fancied and sought after sector in the market right now, but the entire healthcare diagnostic space, hospitals included in there, anything that's looking good?
Yeah, I think healthcare is one of the large portfolio weightage for us. For us, the healthcare and pharma, there are multiple subsectors within that. So we have really low exposure to US link businesses, so less of generics kind of a companies. And second box is the domestic pharma companies, and we like here a few names. I think it provides very good, what I would say, opportunity, keeping in mind next to 12, 18 months view. Third is basically the hospitals, and fourth is diagnostic. So we have a zero exposure to diagnostic, but we have a reasonably good exposure on the hospital business again. And here we are seeing a significant expansion by the top 3-4 players, and interesting opportunities are there in hospital segment. Of course, the fifth box is the CDMO. That's the one space which we have been bullish from last few years, and we continue to like CDMO as a space. Overall, I think the pharma as a sector will continue to provide solid growth, particularly in a macro uncertain environment. the growth is, what is going to be, I think everybody is going to look for growth, and it's not going to be very easy for other sectors to report that kind of a growth. So pharma and healthcare will continue to, I would say, attract the attention of the market because growth is, solid, and the valuations are still reasonable compared to many other sectors where growth is missing and valuations are still absurdly high.
All right, but Rajesh, also help us understand what's your outlook on the auto ancillary space. The reason I ask is because for the OEM side, a majority, when it comes to the passenger vehicle segment specifically, they are more dependent on the domestic market. But auto ancillary as a space, a lot of these experts are highlighting stands a chance to win with China taking the tariff hit. Any particular segment that you believe where India could be the winner?
Well, I think, as you rightly said, the growth of auto ancillary is dependent on two things. One is, of course, the domestic growth, which is right now not that on solid wicket. Both four-wheeler and two-wheeler growth has been kind of a very low single digit, which is not good news for ancillary companies in general. And other is, of course, the export opportunities. Now, this third opportunity of this China plus one, that people have been talking from last 1, 2, 3 years, it is happening slowly, steadily. And we need to, instead of doing the sector-specific view here, we need to be stock-specific. And there are 1 or 2, 3 interesting opportunities here. We are holding one of the large auto ancillary company from almost, I would say, last few years. And that company is, of course, doing extremely well because the opportunity is content per vehicle, and that is going up. So I think, anybody buying auto ancillary just because of hope story, I don't think will be the right thing to do. You need to identify company, whether that hope comes right or not, a separate issue. But even on otherwise, on standalone basis, the company must be gaining the market share. Company must be gaining the more clients and more markets and more geographies. And if that thesis plays out, this, what we are talking about, this China plus one can be the added trigger. But I think there are only 2, 3, 4 companies which can capitalize on these opportunities. And it is not so easy to move the supply chain from one country to other country, particularly in auto ancillary. It's a very, very long drawn process.
Okay, Rajesh, so good having you on the show. Thanks for your time as always.
Thank you.
Okay, on that note, we're going to take a very quick break. Come right back. We'll continue tracking markets on the other side. Back with closing trades right here on ET now. Well, we are just quietly consolidating. It's the broader markets which are very, very lively. Phoenix, Burjett Paints, Max Healthcare, Dixon, 361 WAM. These are all names which are holding on very, very smartly in trade. In fact, pretty much all the big winners from within the F&O segment at least are all from within the mid and the small cap indexes. There's Colgate as well, which has also sprung up about almost nearly 5% as we speak right now. And we'll just dig out some of the other winners as well in just a short while from now. But IndusInd Bank, that within the entire banking pack is sulking, and trouble clearly seems to be continuing for IndusInd Bank, putting the stock under pressure today as the board has now appointed another auditor to conduct fresh probe in the microfinance portfolio. Ankur Mishra, my colleague, is here with exclusive details on what he's picking up on IndusInd Bank.
Yes, IndusInd Bank likely to have appointed an external auditor to conduct probe into microfinance portfolio. Now, remember, as far as the discrepancy in derivatives portfolio are concerned, 2 auditors were appointed, while PwC report is already out where the quantum of loss has been identified as less than rupees 2,000 crore, but Grant Thornton report is still awaited, which is likely to conduct the probe whether or not there was a problem in any of the policies, any of the practices which banks was following earlier. Now, microfinance portfolio probe is being conducted for financial year 2025, whether or not there was a problem in Q2 and Q3 of interest income accrual in the portfolio. The discrepancy is likely to be around rupees 600 crore that has been identified in the annual audit of the bank, and now bank wants to ensure whether or not there was a fraud or any of the wrongdoing in the portfolio. Therefore, now external audit will be conducted of microfinance portfolio. But let me give a disclaimer, this does not confirm that there was any problem in the portfolio. This is an exercise which is being conducted by the bank to be ensured that the policies were followed, the accounting practices were followed to the fullest by the bank, and now that will be cleared by an auditor.
All right, thank you so much, Ankur, for getting us all those details. Why IndusInd Bank is hammered in today's trading session, helping us understand. But taking a look at the markets, we have cooled off from those day's highest point, because for Nifty 50 is just 53 points of gain is what we are witnessing, while Nifty Bank is up around 373 odd points at one point in time. We also scaled gains of over 550 odd points. But nevertheless, there are financials, the FMCG basket that is doing pretty well for itself today. And other than that, within the broader market space, be it healthcare, be it some of these oil and gas counters, they are participating in the rally too. But let me also welcome Shivangi Sharda, who is joining us on the show right now, as well as we also have Ashi Anand on the show. A very good afternoon to both of you, and thank you so much for your time. But Shivangi, let me come to you first to have your take on Dixon Technologies, because I believe as a house you track this stock very closely. And of late, with this whole US-China tariff war coming in, this is one of the sectors that is expected to be beneficiaries, and we have seen the news flow around. But on the technical front, where do you see Dixon Technologies headed, Shivangi?
Having me. So we've seen that Dixon Technologies has come out from a sector which hasn't moved very much in the last 2 to 3 months. But overall, there has been outperformance here from the last 1 month, 1 odd month. So of course, there is tailwind which this stock is carrying. From the last 2 to 3 sessions, specifically, price volume surge has been quite remarkable. And from the last 3 weeks, we've seen a very sharp comeback of the bulls in this stock, which was earlier very lackluster. So, of course, this momentum is going to continue. And technically speaking, there is a lot of open interest activity that is happening as well. So, looking quite positive for around about 17,250 odd levels. And, a good support could be watched out at 16,400 level.
Okay, that's that on some of the buzzing names. Ashi, hi, afternoon. What's it looking like in the market? And it seems like clear leadership from within banks. Anything that you may have added in your portfolios of late?
Sure, hi. Actually, our portfolio has been fairly stable. We've seen quite a sharp bounce back from the lows. Our kind of view is that the market outlook hasn't, while there are clearly certain things that have improved. RBI has cut rates. RBI is also easing up on liquidity. Oil prices are down. And the kind of tariffs have been kind of paused for a certain period of time. We don't yet completely believe that we are out of the woods with the kind of current rally back from the lows. You are now just kind of about 7 to 8% down on the large cap indices from the highs, about 15% down on small caps from the highs. Given the fairly aggressive bounce back, I think we continue our kind of fairly moderate or conservative stance. We have about 6 to 7% cash across both of our portfolios. We're just kind of waiting to kind of see how news flows develops. We are importantly kind of just keeping a close eye on corporate earnings to see the kind of outlook on earnings going forward in the coming year before we really go in and look at deploying this cash. So at least as of right now, there have been no major changes at the portfolio level.
All right, but with this, let's move on and let's put the spotlight on shining gold, because that has definitely created history. And if you wish to buy a gold, 10 grams of gold rather, then you have to pay over $1 lakh for it in the physical market, including GST. The big question is that what is fueling this rally? Let's get in Ashesha, who is here with all the details of what exactly is happening when it comes to gold as a commodity.
Well, yes, gold has indeed created history, and as you mentioned, it has crossed that 1 lakh rupee per 10 gram mark in the physical market. So the last traded price stands at about 98,900 rupees for 10 gram, and with 3% additional GST, the price stands at about 1,02,000 rupees for 10 gram. Several factors leading the move.
but let's also talk about global prices, because in the global market, gold has crossed that $3,482 per ounce mark, and in the last just 2 days alone, gold prices have risen nearly 2.5 to 3% on a year-to-date basis. Gold is up nearly 30%, which is more than the returns gold had given last year in dollar terms. In calendar year 2024, gold was up 27%. This was followed by a 13% return in calendar year 2023. Latest trigger, of course, being the commentary that came in from US President Donald Trump with respect to Jerome Powell and with respect to commentary on interest rate environment and tariff war, which continues to escalate. Geopolitical tensions, and central bank continues to buy gold globally. So these are some of the factors which continue to aid the move that we are seeing in the yellow metal. But apart from that, despite the up move that we have seen, global brokerage houses continue to remain very positive. Goldman Sachs continues to remain positive. They've given a target of $4,000 per ounce by mid-2026. And apart from that, monetary easing is also expected to be a positive, and traders expect at least 3 rate cuts in this calendar year. So several factors aiding the move, but for now in the domestic market, gold prices have crossed that 1 lakh rupee per 10 gram mark on MCX.
Okay, that's Darren Gold. And Kunal, you've been telling us for a while right now that better than equities in the near term is actually gold. How much more can it go from 1 lakh?
No, not better than equities, of course, yeah. But yeah, almost there, 1 lakh. This is a phenomenal move. Completely, I think, taken many of the people off guard. Because, I think, I remember from 83, 84,000 when gold was trading at those levels in February or March, there was a point where, there was expectation that maybe gold prices would probably have hit the roof and we could be looking at, a bit of a correction or a reversal of sorts, but that's not happened. And I think now, the momentum is extremely strong. I looked at the historical instances when gold prices, they generally tend to top out or at least show signs of extreme overbought. That generally happens when you see quarterly RSIs for gold, both in terms of dollar as well as in terms of the rupee prices, hitting levels of 90 plus. Right now, we are still at 86.5 to 87 on the RSIs for gold on both these rupee as well as on the dollar terms. So I think that generally indicates that there should be more room on the upside for gold prices to move further.
So there could be some more headroom for the gold prices to move higher. But amid the uncertain and the volatile times in the markets, the only asset class that's managed to retain its sheen is gold. But amid the record peaks, is there merit in exercising some caution? Is the correction in sight over the near term? We spoke to a whole host of voices, from Chris Wood of Jefferies to Enam Holdings, Sridhar Sivaram, all going long on yellow metal with sounding warnings against a near-term correction. Let's go across and listen in.
I think gold could have a big correction at any time, but I think gold will be higher in a year's time. I would advise people with long positions in gold to continue to hold and just take profits at the margin. Obviously, if you own gold on leverage, you should take some profits, but gold's trading very well.
So what we were trying to say with the gold long was that bad behavior has its consequences, and people start to lose faith, especially in the currencies that central banks and governments are printing, paper money. So it was time to be much, much more aligned with the old-fashioned currency, the one that doesn't get printed out of existence, and that's gold.
I own gold and silver, and I bought more silver recently. Silver's still depressed. Those are two of the few. Well, I'm not buying gold because it's making highs. I hope I never sell my gold. I hope that my children own my gold someday. I am not selling my gold, even though it's making all-time highs.
Gold is extremely expensive in any metric. Of course, you guys all putting out this charts that, Nifty has, of course, underperformed gold for last couple of 2 decades at least. So very, very expensive for a zero coupon infinite bond. It's very expensive. From an allocation point of view, it's time to be sort of super concerned about gold valuations now. So I don't think it's a time to dial up gold in any meaningful fashion.
Gold is up almost 50% in the last 1 year, despite the correction that we are seeing. You can't have an asset class keep going up, one way. I'm a big bull on gold, but I'm saying that it's gone up too fast, too soon. So there will be some correction, but over a period of time, I'm still bullish on gold, that this is an asset class which will do well, but it can't go up 50% every year.
All right, so those were the big voices when it comes to gold and where is that headed. But let's get back to the markets, and what we are seeing is a bit of a resilience that at least the index is showing in today's trading session. But on the flip side, it's the two-wheeler counters that are a bit under pressure. Stocks like Hero MotoCorp and Bajaj Auto are a bit under pressure on the back of the Jefferies downgrade coming in. But Ashi, I beg your pardon, what's your take and what is your preference looking like when it comes to the two-wheeler counters?
So two-wheelers is a space we honestly aren't very positive about. It's very important to kind of understand that when you are buying a company, you're buying a future set of cash flows. If you understand what's happening from a slightly longer term perspective in two-wheelers, this is a space which is going to see the most rapid transformation towards EVs. And I think the longer term competitive dynamics of EVs is still unclear. You don't really know how longer term market share dynamics are going to pan out. You don't know how profitability is going to pan out in the longer term. So two-wheelers is really a space where over the last kind of decade and a half, these companies used to have very high profitability levels, very strong cash flows, a fairly kind of a stable competitive kind of scenario between Hero, Bajaj, and kind of TVS are dominating the entire space. But as you're getting into kind of EVs and EVs becoming a larger share of the overall market, you are going to get new competitors coming in. They will take in kind of market share. And as kind of different people are trying to battle to kind of gain market share, pricing and profitability is both going to get impacted. So while they can clearly be shorter term trading plays in the space as demand kind of comes and goes, from a longer term perspective, we see this as a space which is likely to see structural derating.
Right, interesting. That's the take coming in on what the two-wheeler space is seeing. And Ashi, can't help but ask about IT. I mean, yesterday almost seemed like one of those freak days when you had even some negative numbers absorbed very smartly by the street. Do you think a turnaround, at least for stocks, could be around the corner, not as much earnings?
Dependent on how the entire US kind of macroeconomy, trade tariff, what Trump is doing, all of that pans out. At this point in time, the levels of uncertainty are exceedingly high. You've seen very sharp corrections across IT companies over the past kind of 3 to 4 months. And this is corrections of kind of stocks that hadn't really moved earlier. So valuations are kind of exceedingly cheap, but they kind of take into account this overall uncertainty around the kind of US economy. Now, one of two things could happen, right? As in either you have this kind of trade tensions kind of continue, and what happens with US and China is going to be extremely important because that would have an impact on the overall economy, not just US and China, but global. If those trade talks don't kind of start and kind of don't ease down at some point in time, we believe IT could continue to underperform. But if you start to see some respite, given how oversold they are, there could be a bit of a trading pop that there is in IT. So it continues to be a space which is very good from a longer term perspective in terms of the quality of the companies, the profitability, free cash flow generations, etc. But you have a combination of an uncertain near-term kind of US economy. Corporates are accordingly kind of going slow in terms of discretionary spends. And there is a bit of a longer-term overhang in terms of the impact of artificial intelligence. So I think until the US kind of outlook doesn't improve, the space could kind of underperform.
So that's the take coming in on the IT space. But today, of course, all eyes will be on HCL Tech as the company is set to deliver its numbers. But what is the street penciling in? Let's get in all those details from Ansh, who is joining us on the show right now. Ansh, over to you.
HCL Tech is set to report a mute set of numbers for this quarter. So actually in constant currency, we are seeing that revenue is likely to decline by 0.3% sequentially, whereas in dollar terms, revenue is expected to go down by around 0.7% on quarter-on-quarter basis to $3,507 million. Whereas if we talk about in rupee terms, then that is expected to rise by around 1.6%. But the main revenue decline could be on the back of a weak seasonality in product business and continued softness in manufacturing sector. sector. Apart from this, if we talk about margin, then that is likely to decline by around 150 basis points from 19.5% directly to around 18%. And this is mainly on the back of partial wage hikes of senior employees. If we talk about net profits, then that is expected to go down by around 6.4% to 4,298 crore. Now, if we talk about FY26 guidance, then revenue is expected to be in the range of 3 to 5%, whereas operating margin is likely to be in the range of 18 to 19%. But apart from numbers, there are 5 key things to watch out for. First is management commentary on demand. Second is integration and performance of recent acquisitions. Third is discretionary spending outlook. Fourth is deal pipeline and Gen AI opportunities. And fifth is headcount and attrition trends.
Okay, that's that on HCL Technologies. But let's quickly cut across to JD Vance. He's currently talking about Indo-US relations.
Seems stricken by self-doubt and even fear of the future. To them, humanity is always one bad decision away from catastrophe. The world will soon end, they tell us, because we're burning too much fuel, or making too many things, or having too many children. And so, rather than invest in the future, they too often retreat from it. Some of them pass laws that force their nations to use less power. They cancel nuclear and other energy generation facilities, even as their choices, the choices of these leaders, lead to more dependence on foreign adversaries. Meanwhile, their message to their friends, to countries like India, is to tell them that they're not allowed to grow. Well, President Trump rejects these failed ideas. He wants America to grow, he wants India to grow, and he wants to build the future with our partners all over the globe. And when I look at this audience, or when I visit this incredible country over these last couple of days, I see a people that will not be held back. Now, the most profound responsibility I believe that all of us have is not to ourselves, but to the next generation, to make sure we leave them with a better society than the one that our parents and our grandparents gave us. And this is the world that America seeks to create with you. We want to build a bright new world, one that's constantly innovating, one that's helping people to form families, making it easier to build, invest, and trade together in pursuit of common goals. Now, I believe that our nations have much to offer one another, and that's why we come to you as partners looking to strengthen our relationship. Now, we're not here to preach that you do things any one particular way. Too often in the past, Washington approached Prime Minister Modi with an attitude of preachiness, or even one of condescension. Prior administrations saw India as a source of low-cost labor on the one hand, even as they criticized the Prime Minister's government, arguably the most popular in the democratic world, and as I told Prime Minister Modi last night, he's got approval ratings that would make me jealous. But it wasn't just India. This attitude captured too much of our economic relationship with the rest of the world. So we shipped countless jobs overseas, and with them our capacity to make things, from furniture, appliances, and even weapons of war. We traded hard power for soft power, because with economic integration, we were told, would also come peace through sameness. Over time, we'd all assume the same sort of bland, secular, universal values, no matter where you lived. The world was flat after all. That was the thesis, and that was what they told us. And when that thesis proved false, or at least incomplete, leaders in the West took it upon themselves to flatten it by any means necessary. But many people across the world, and I think your country counts among them, they did not want to be flattened. Many were proud of where they came from, their way of life, the kind of jobs they worked, and the kind of jobs their parents worked before them. And that very much includes people in my own country, the United States of America. Now, some of you are aware of my own background. I actually didn't plan to talk about my background at all until last night at dinner, while my children mostly behaved. We gave them an A- for behavior with the Prime Minister. The Prime Minister said, I have one request. I want you to talk a little bit about your background. And so I wanted to do that. For those of you who don't know anything about me, I wanted to talk about it. I come from, and I'm biased, the greatest state in the Union, the state of Ohio, a longtime manufacturing powerhouse in the United States of America. My home specifically is a place called Middletown. Now, it's not a massive city by any means. It's not Jaipur, but it's a decent-sized town and a place where people make things, which has been a point of pride in Middletown for generations. It's filled with families like my own, some of whom called us hillbillies, Americans who came down from the surrounding hills and mountains of West Virginia, Tennessee, and Kentucky to cities like Middletown in pursuit of the manufacturing jobs that were creating widespread prosperity for families all across America. They came to Middletown in search of what we call back home the American dream. In Middletown, my parents raised me. My grandparents raised me. They taught us to work hard. They taught me to study hard. And they taught me to love God and my country and always be good to your own. My granddad, who I called Papaw growing up, he typified that. Late into life, he worked as a steelmaker at the local mill. And I know India has a lot of those. Papaw's job gave him a good wage, stable hours, and a generous pension. All that allowed him to support not just him and my grandmother, but his own daughter and grandkids with him. Now, by the time I came around, money was awfully tight, but he worked hard to make a good living for all of us. Now, I know Papaw and Mamaw were grateful for the way of life their country made possible. Their generation bore witness to the formation of America's great middle class. And by creating an economy centered around production, around workers who build things, and around the value of their labor, our nation's leaders then transformed their country and made thousands of little Middletowns possible. The government supported its labor force. We created incentives for productive industries to take root and struck good deals with international partners to sell the goods made in the United States of America. But as America settled into world historic prosperity it generated, our leaders began to take that very prosperity and what created it for granted. They forgot the importance of building, of supporting productive industry, of striking fair deals, and of supporting our workers and their families. And as time went on, we saw the consequences. In my hometown, factories left, jobs evaporated, America's middle towns ceased to be the lifeblood of our nation's economy. And the United States, as it became transformed, those very people, the working class, the background of the United States of America, were dismissed as backwards for holding on to the values their people had held dear for generations. Now, Middletown's story is my story, but it's hardly unusual in the United States of America. There are tens of millions of Americans who, over the last 20 or so years, have woken up to what's happening in our nation. But I believe they woke up well before it's too late. Now, like you, we want to appreciate our history, our culture, our religion. We want to do commerce and strike good deals with our friends. We want to found our vision of the future upon the proud recognition of our heritage rather than self-loathing and fear. I work for a president who has long understood all of this, whether through fighting those who seek to erase American history or in support of fair trade deals abroad. He has been consistent on these issues for decades. And as a result, under the Trump administration, America now has a government that has learned from the mistakes of the past. It's why President Trump cares so deeply about protecting the manufacturing economy that is the lifeblood of American prosperity and making sure America's workers have opportunities for good jobs. As we saw earlier this month, he will go to extraordinary lengths to protect and expand those opportunities for all Americans. And so today I come here with a simple message. Our administration seeks trade partners on the basis of fairness and of shared national interests. We want to build relationships with our foreign partners who respect their workers, who don't suppress their wages to boost exports, but respect the value of their labor. We want partners that are committed to working with America to build things, not just allowing themselves to become a conduit for transshipping others' goods. And finally, we want to partner with people and countries who recognize the historic nature of the moment we're in, of the need to come together and build something truly new, a system of global trade that is balanced, one that is open, and one that is stable and fair. Now, I want to be clear, America's partners need not look exactly like America, nor must our governments do everything exactly the same way. But we should have some common goals, and I believe here in India we do. in both economics and in national security. And that's why we're so excited. That's why I'm so excited to be here today. In India, America has a friend, and we seek to strengthen the warm bonds our great nations already share. Now, critics have attacked my president, President Trump, for starting a trade war in an effort to bring back the jobs of the past, but nothing could be further from the truth. He seeks to rebalance global trade so that America, with friends like India, can build a future worth having for all of our people together. And when President Trump and Prime Minister Modi announced in February that our countries aim to more than double our bilateral trade to $500 billion by the end of the decade, I know that both of them meant it. And I'm encouraged by everything our nations are doing to get us there. As many of you are aware, both of our governments are hard at work on a trade agreement built on shared priorities, like creating new jobs, building durable supply chains, and achieving prosperity for our workers. In our meeting yesterday, Prime Minister Modi and I made very good progress on all of those points. And we were especially excited to formally announce that America and India have officially finalized the terms of reference for the trade negotiation. I think this is a vital step. Thank you. I believe this is a vital step toward realizing President Trump's and Prime Minister Modi's vision, because it sets a roadmap toward a final deal between our nations. I believe there is much that America and India can accomplish together.